Good morning and welcome to the Killik podcast for Friday the 20th of February. It's been a good week for the Footsie, which has surprised many given the events in Greece at the moment. And we're seeing the market on a relatively overbought level on a technical indicator up at that level that we've seen previous pullbacks. So it's prompted us to sort of go back and look at the value that we're seeing in the Footsie at the moment. So taking a longer term chart, this is 2007, we saw a big pullback into the base in March 2009, and then quite a material rally. And within that, we've seen a number of sort of pullbacks and then rallies. So a 17% pullback in 2010, followed by a 25% rally, then 11% pullback in 2011, followed by a 36% rally into the current range, which has largely been a base of 6,000 and a top of 6,800. Within that, we've seen more recently 12% pullback and 8% pullback, and then in January a short 5% pullback. So where do we feel we are in terms of the market, and are we now going to go on to new highs? Well, our year-end target is 7,200, and that implies a modest 5% earnings growth for the year, and the Footsie ending the year on 13.2 times with a prospective yield of 4%. That is around 4.5% above here in terms of capital, and then we're looking at the 4% yield, so that's an 8.5% total return for the year from where we are at the moment. So how does 13 times sit in the relative picture? Well, 13 times on the Footsie is an earnings yield of 7.5%. So we always look at the earnings yield on the market relative to what you're getting in the bond market. So the gilt yield, the 10-year gilt, is currently 1.8%. So you're getting an equity risk premium of 5.7%. So this is the level you're getting paid for holding equities rather than being in bonds. In terms of where we are in terms of history, recent history would suggest that that's still pretty cheap for a market. So above here, you've got a situation where credit is expensive and the equity market is relatively cheap. And as you can see here, we're still well above the average in terms of the equity market being cheap. Other developed markets have now moved ahead through their previous highs. Here you can see the S&P and the DAX. They're well into new territory, and that sort of gap can be attributed to the oil and the mining exposure within the FTSE 100. On a price to earnings level, the S&P, even though it has moved on, we feel is still at a pretty reasonable level in terms of PE. As you can see, you've got an expansion there in the price to earnings, but it's still well below previous bubble territory, particularly in 1999 that we've seen then. So we feel that can continue to progress, and it will progress and be supported if earnings continue to be picking up. And this year we've seen, and it's usually instructive for the year ahead, what happens in January, seen a strong rally in the cyclicals and the financials. They're the growth-sensitive stocks, and if we feel that growth is accelerating, these sorts of areas do well, as do the smaller companies markets, which have been picking up quite significantly year to date. So what will make us change our mind about this cycle and suggest to us that we're near a top of the cycle? Well, we're looking at behavioural issues and behavioural excess. So at the consumer level, we don't see that at all. So consumer confidence is gradually recovering, but it's still well below previous highs where we saw strong market pullbacks. Equally, in terms of the behavioural patterns of households in terms of their own balance sheets, again, we're still seeing household debt coming down relative to income. That's a very supportive picture for earnings. Equally, at the CapEx, at the corporate level, CapEx to sales remains very, very reasonable, and inventory to sales levels remain very reasonable. So we're still seeing companies taking their earnings and buying back stock and paying dividends rather than going into expensive expansionary programs that tend to mark the peak for markets. So next week we're looking at Lloyds reporting on Friday, so just a quick review of that. Here you can see the Lloyds share price has been pretty static since 2013 as it's reached that 74p government in price, which has been seen as a bit of a top for for the stock. We like banks, as we've talked about a number of times. They continue to under-earn, in our view, in this low interest rate environment. And Lloyds trades at a discount to the sector on 8.7 versus 9.5 times PE. That's a price to book of 1.4 times on a return on tangible equity of 15, which looks very reasonable to us. Key catalyst for Lloyds, we feel, will be getting closer to that targeted 60% payout for their dividends. So they're going to pay 60% of their earnings. And on 2016 earnings, that's 5p of dividend, or a 6.5% yield, which obviously is very attractive in this environment. So going into the numbers on Friday, we expect asset quality to be stable. Their book is pretty cautious. Cost cutting to be ongoing. And we also feel that a lot of the issues in terms of regulatory fines and conduct costs are already factored into that stock. The key risks for Lloyds continue to be a Labour victory, as they've got plans to disrupt some of the UK banking infrastructure, and the UK housing market correction. That would obviously be a negative for the stock. So other stocks reporting next week, we've got BHP and HSBC on Monday, GKN on Tuesday, Weir Group and Man Group on Wednesday. On Thursday, we have RBS, and then Friday we've got Lloyds, Airbus and BAS and Amadeus. So pretty busy week. Just looking at Airbus in a little bit more detail because it's on our best ideas list. Airbus for us is a good way to play QE. It's been a very strong share price since QE was announced, and that's because it's positively geared to a weak euro. And the point of QE is to weaken the euro. So 60% of their sales are in dollars, and their costs are predominantly in euros. So that's showing a good net effect for their profits. Equally, we also like the longer term story. So we're seeing emerging markets expand their fleets, the emerging market airlines. You're also seeing quite a significant replacement cycle from less efficient aircraft. So they've got a significant backlog of over 9 years, which gives us great revenue visibility. In terms of margins, that's probably been the key concern about the group. They've got a lot of very expensive long-term programs, but the mix of that is starting to look more attractive. So the A350 program has matured, and we're seeing the A380 moving towards break-even. So improved cash flow, improved margins, strong revenue outlook makes Airbus a very attractive stock to us. So that's it for me. Thanks for listening. Have a good weekend.